Hello all and welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. You asked for it and we're delivering it. The viewers have been asking how to get access to those juicy 4% yields on the 2-year treasuries, as well as other portions of the Fed's treasury market. There's new products recently launched to go a long way toward answering those needs. Let's talk with Alex Morris. He's the CIO of FM Investments. He's just launched a new series of single bond treasury ETFs. Also joining us, my old buddy John Davey, founder and chief investment officer for Astoria Portfolio Advisors. Alex, we've talked about single stock ETFs on this show for a long time, the Tesla long and short ETF, for example. Single bond ETFs are really new. You've got a 10-year, a 2-year, a 3-month that launched in August. Tell us, for example, about the 2-year. Tell us how this whole thing works. What are you getting when you buy this? Sure.
So you're getting access to the U.S. Treasury on the run 2-year. It's cash bond. There's no leverage. There's no derivatives. It's quite different than a single stock ETF. And in that sense, it's simpler. It's easier. You get access to what you would buy if you were to go and purchase an ETF. Sorry, a 2-year Treasury on its own.
So every month, and you see the notes here, there is a new auction of 2-year notes. That happens every month. We know that. And you sell the old one and you buy the new one, right? So you always have the most recent auction.
Correct.
Now, this is not free. You charge 15 basis points for this. So you don't necessarily, you're not actually going to get the exact number when the fees are deducted. But taxable events.
No taxable events. So
right, and that's because of the magic of ETFs,
exactly.
Right? Because the market maker actually is the one who does the trading, and there's no taxable event.
Exactly.
Explain that to people.
So when you roll the Treasury from, say, last month's to this month's, if there's a negative event, we would just make a trade. But if there's a positive capital gain, we'll go out and we'll work with the market maker to eliminate that. And since we're going to roll it 12 times a year, we know that's coming, which is good news for us because we can plan with the market makers to get really good pricing when that happens. So you're not worried about, are we a good trader? You're worried more about, are we planning appropriately? And the answer is given the regularity of the auctions, we can do that. And to date, we've done trading at the NAV itself. So the fund hasn't paid for liquidity. The shareholders haven't paid for that liquidity. And they've not experienced a taxable event as a result.
Yeah, so John, we've got single stock ETFs. Now we have these single bond ETFs. You're an investment advisor. That's why we have you here. Is there room for these kinds of investments? I mean, where would they fit in, for example, as an investment advisor? Is there circumstances under which you would recommend them, or would you just say, yeah, just go to the Treasury Direct and buy them? Try to tell us how you use these.
Sure. So in full disclosure, we've been buying it direct from the Treasury Direct, so at our custodians. Maybe we should look at Alex's funds. But for me as a multi-asset investor that's allocated across stocks, bonds, commodities, alternatives, for me, like the game has changed now that Fed funds is at 3, on its way to 4. The 2 years is at 4.3%. I think stocks have competition. So what we've been telling our advisors, our clients, is like, look, you don't have to be long just stocks at this point. You should be clipping coupons vis-a-vis, the 2-year Treasury. I think that's a sweet spot. We've been going, direct to the government, but perhaps we should be looking at Alex's product. They seem to make a lot of sense. They do the role for you. So effectively, I'm just outsourcing my role to Alex's firm, which we're not opposed to. There's a cost, like you said, 15 basis points. But conceptually, the idea that you want to own treasuries, I think makes a lot of sense.
Yeah, so you were mentioning stocks, bonds, commodities. Diversification is the key here. You're only owning a very specific product within the bond universe. So obviously, we generally, being a Jack Bogle disciple, you want diversification too, as well. You don't want everybody just throwing their money at a 2-year note, for example.
Yeah, and we've been laddering bonds across not only treasuries, but municipals and corporates. So we've been using some of these bullet share products, BSCO, BSMO. So those are for corporates, and they're for munis, and that's the 2024 maturity. So I agree with you, Bob. Own not just treasuries, but also other fixed income securities.
Right. So, and I know this is an educational moment to explain to people why own a single bond ETF versus, say, going on Treasury Direct, which is the website, and buying just a 2-year bond, for example. What's the difference and what advantages do you have?
Sure. So I encourage folks to try it. I mean, the Treasury Direct is access to the government. It's the real deal. But it's somewhat complicated. Bond math is hard. It's the part of finance most folks prefer to forget or never have done in the first place. The cash flows are messy. Getting a 1099 with all of the action of accretion and coupon payments is sometimes off-putting. It's much easier to buy the ETF, and since we give you direct access, it's essentially the same proxy. It's also easier to trade, it's easier to rebalance. There's no commission at most places when you charge it. And the market makers have done a great job keeping the spreads tight, often tighter than most folks would get trading the bond itself.
And what's the advantage of rolling over every month?
Ultimately, it's liquidity. Most risk managers want to be on the run at the most.
Because that's the most liquid one.
It's the most liquid by a wide margin. When you move even a month or two off, the spreads can triple or 5 or 6x, which doesn't sound like much, but when you're buying tens of thousands of units, that's a very large number very quickly. So the on-the-run tends to be the most liquid. The on-the-run 10-year, for example, underpins most of the global financial infrastructure we come to. It prices everything from mortgages to car loans to what the forward valuation on the NASDAQ is ultimately going to be.
Right.
So staying on the run is important, and for most folks, that liquidity when you want it is what's there. If we go back to March 8th, 2020, some of the spreads on multi-bond products got very large. And it wasn't because the on-the-run treasuries lost liquidity or the treasury market dried up. It was those market makers also had to move a substantial number of bonds that were not particularly popular.
Yeah. So who's your target audience here? Is it the buy and hold crowd? Is it active traders? I mean, one thing that strikes me as very interesting is you could short this, right?
You certainly
So this
can.
could be part of some kind of portfolio where you're doing some very complicated maneuvers, going long and short equities or long and short bond funds, for example.
Exactly. So we think treasuries are probably appropriate for most folks, but long term, we suspect that the active user set are advisors who have a very specific interest in being a certain place on the curve, as well as in some institutions who don't want to do the rolls on their own. And then finally, some retail investors who traditionally haven't had access to some of the rates mechanisms that institutional investors have. So if you want to, you could always buy a future on a bond. It's $1,000 a point, 32 points per percentage point. And there's a lot of math to do that and a lot of leverage.
You know, John, one of the obvious advantages of a single bond ETF is that I get this complaint all the time. Multi-bond ETFs, you're locking in all these low yields potentially for several years down the road. I get people saying, I can't get this yield on my multi-bond ETFs. Well, the reason you can't is they own old bonds that have lousy yields on them. So, I mean, this strikes me as another interesting reason why people might want to just stay with the front, whatever the on the run, as he calls them.
Yeah, I think Alex's firm is always going to roll it for you. So, effectively, you get the latest, bond. So that seems to make sense to me. I just think big picture, like, we want to be laddered. We want on targeted maturities because, the curve is very flat. So I like the 2-year, it's a sweet spot. I don't know if I would be going out and buying like LQD specifically or J&K specifically. Like, I think
LQD is the largest corporate bond ETF.
Right.
It's a basket of corporate bonds of different maturities.
Correct. It's a basket, thousands of bonds, investment grade corporates. J&K is, the high yield bond ETF that gives you, again, exposure to a broad basket of junk bonds. But I think like my message is to get laddered and specific maturities, given that the curve is pretty flat. 2 years is a sweet spot, and it sounds like what Alex's firm is doing is outsourcing the roll-in. So I think for your question before, it makes sense for people that don't want to sit on their computers and roll their bond, maturities constantly. So it's another extension of the ETF ecosystem, just outsourcing the portfolio management to another firm.
Now, are we expecting, just like single stock ETFs are proliferating like rabbits, or are we going to see single bond ETFs proliferating? You're going to launch other products, right?
We are. I hadn't thought about the rabbit analogy, but yeah, so we're looking at launching a 6-month and a 12-month and a 30-year, which will round out the sort of short end of the curve, so folks can have access to that very steep part. As John points out, the middle part of the curve is pretty flat, but we do know folks have some interest in the long bonds, just add duration to portfolios and for all of the other risk management characteristics of having a 30-year treasury.
Can you see this happening internationally, launching gilts, for example, or German bonds? Is that feasible?
So we couldn't launch a single gilt ETF, although that would be fairly spicy today, simply because it wouldn't be an ETF. It would be an ETN. The government, the IRS, actually sets the ETF rule, and the issues were concentration. But they have one exception, treasuries. So all of the ETFs that buy treasuries are invested 100% in one issuer. It's the United States government. But the cash exemption rule allows us to hold just that security.
Could you have a single bond corporate bond ETF? Could you launch a GE corporate bond ETF for, you know, if they had an auction, for example, or they launched a new bond?
You could offer it as a product, but it wouldn't qualify under the tax code as best we've been advised as an ETF, because it would violate the issuer concentration. You could try, like many of the single stock ETFs, to create a swap or some.
When you say it would violate the issuer concentration, what does that mean?
There's a rule that requires you to hold no more than 25%, sorry, in any one issuer. So as a result, you have to hold 5 things: 4 issuers at minimum in cash, or 5 issuers. The government is a single issuer, but it's exempted itself from that rule. So it's why when you look at the single stock ETFs, they actually hold a swap and a handful of other things. 1, to get some leverage, and 2, because if they held just one issuer, they wouldn't qualify for the tax benefits of an ETF.
Yeah, it's a very good point. John, I want to, while I have you here, ask you about the broader market. Obviously, we're down, S&P's down 24% this year. Viewers are writing in asking what they should be doing. Should they put more money into bonds? But bonds are down this year really big. I'm a market historian, and so are you, about this. I always tell people to use that old British line, keep calm and carry on. Mm-hmm. It is extremely unusual to have a down 24% year. In fact, it's only happened 15 times since 1926. I tell people that they don't believe me. But maybe you can point out how unusual this is and how usually the following year is a bounce back. It's almost invariably an up year the following year.
Yeah, that's a good point. So back-to-back down 20% years is very rare. You have to go back to the 1930s where we had 2 consecutive years of down 20. I feel like when I look at Wall Street research or I turn on CNBC, everyone is extremely bearish. My point is, if I look at our portfolio, going into this year, we were extremely defensively positioned. We owned a lot of alternatives. We had inflation fighting strategies. Most of our exposure was to the quality factor. We own a lot of like short duration bonds, cash-like bonds. So on a relative basis, our clients have experienced a lot different portfolio returns this year compared to like our benchmark. Needs to say, Bob, like I just think for me to be as bearish now for the next 6 to 12 months is just not the view that we have. Like we think at Astoria that yes, could there be an earnings recession? Absolutely. And I read your note today. I actually agree with what you wrote in your blog. Are there other risks out there? Can more UK pension funds blow up? Yes, but like my edge and Astoria's edge isn't like trying to predict the next UK pension fund from blowing up. So I just think like our operating word is like start to nibble, nibble on stocks, high quality stocks, look at bonds because bonds now are yielding you some attractive, coupons, with the goal of trying to deploy that cash in the next 3 to 6 months. And that is a very different view. Like, again, when I watch TV or I read research, like everyone's like run for the hills. But my point is that like we've already had our DEFCON 5 moment. Like the average stock is down like 30%. So, and I just don't see that playbook going forward.
You know, I'm a Jack Bogle disciple, and one of the things Jack used to say is don't just do something, stand there. That often the best strategy is to do nothing. And you do make serious mistakes when you start second guessing your strategy and saying, oh my God, I got to do something. That's when you make mistakes. As most people know, market timing doesn't work. You have to be right going in and going out, and it's extraordinary how many mistakes that you can make. I want to reiterate that again. It's only been 15 times since 1926 the S&P is down 20% year over year, and 2/3 of the times the following year you were made whole again. In other words, you bounced back within a year. Years where you don't bounce back dramatically are not that common. I also want to point out the direction of the S&P has always historically been up. It's up 3 out of 4 years. 72% of the time, the S&P 500 is higher year over year since the 1920s. 72%, 3 out of 4 years. And normally it goes up big. 56%, I'm sorry to be professorial, but it's important to point this out. John has all these statistics. 56% of the time, the S&P 500 is up 10% or more a year. 56% of the time since the 1920s. Only 12% of the time is it down 10% or more. So you see the market direction is up. And John, as you know, people say, well, why is that? Well, it's because capitalism. Capitalism is, some people hate capitalism. Winston Churchill said it was, democracy was the worst form of political system except for all the others. Capitalism is the worst economic system except for all the others. And the relentless efficiency of capitalism, and particularly relentless efficiency of American corporations at capital allocation is why the U.S. does so well. So I know, John, you do this lecture on capitalism and why we need to keep investing in the markets, but I try to walk people off, the viewers who write me in saying, oh my God, we're going to fall apart, the world's going to go to hell. I said, only if you think capitalism in the U.S. is going to go to hell, and I don't. That is not my base case. It never has been.
Yeah.
So people need to be reminded about the fundamentals of investing and where we go from here. Where is your base case for the S&P 500 by the end of the year?
Well, I think there's some downside risk to earnings, potentially being worse than expected. But I think, inflation is what got us, in this, bear market recession. I think the stock market is obviously priced in a recession. For you to be bearish now, thinking there's another 10, 15% decline in S&P means that you believe that we're going into a protracted, elongated recession. I don't see that. I see inflation, all these forward-looking inflation indicators actually materially declined, whether you look at gasoline, commodities, timber, break-even. So I'm more constructive. I think probably there's maybe 5 to 10% downside in S&P. I think the key is whether or not these earnings actually are lower and comes in worse than expected. Yeah. But again, we try not to predict what's going to happen, but just use buy high quality stocks, buy value stocks, look where there's a margin of safety. 10, 11 times PE ratio for value stocks, I think, is enough.
Yeah, and Alex, one of the things people ask me all the time is, well, gee, shouldn't I do something? I said, how long are you going to live for? If you're a 30 or 40-year-old guy, you're going to have another 50 years of investing. This year is not going to matter.
Right.
So, telling people about historical perspectives is really important. You have 50 more years as an investor if you're 40 years old even, and a lot more if you're younger than that. And that's kind of the way to look at this, I think. And the important thing is you think you want to pull out all your money now and you know when to put it back in. You don't. So my favorite charts are, what happens if you invested $1,000 in the S&P and pick a date, 1970, and now you have $300,000. But if you miss the 5 best up days, you'd only have $200,000, and the best 10 you'd have significantly lower. And you don't know when those 5 best days are. That's the problem with the stock market. You don't know. And so the odds are you have to stay in the game, knowing that the long-term trend is up. And by the way, yes, it's true, if you were not in on the 5 worst days, you'd still do better. But the trend is always up, long-term. So that's what the game is. It's a long-term, game that's out there, Alex.
Well, that's why, if you look the way we structured our products as an infinite time horizon, this is an infinite game for folks. Yes, we may have certain spending needs we want or certain objectives, but long-term, if you want to make money, you're going to have to be in the market.
You don't need to do a lot of marketing, do you? I mean, this is a wonderful product for you in the right year. You just launched this in August, right?
We did, yeah.
I mean, if you would have done this 3 years ago, I would have said, why and who cares?
I don't think we would have had the support to do it 3 years ago. We did this because advisors were asking for it. For our clients would call up and say, what happens if, looking at valuations going into January? And our answer was, we'll go to the treasuries. The treasury market generally has positive yield and negative correlation to equities, particularly U.S. equities.
Yeah.
So that's your refuge. But it's somewhat complicated, and really in anticipation of a large interest in treasuries, we looked at multi-bond treasury funds, but didn't get the liquidity we wanted. We were a little worried by some of those funds on March 8th, 2020, and how big those discounts and premiums were and how long it took for those to come back in. And that's when we decided to launch the products. It just made sense to give access.
Well, it's nice to have, we used to say, Tina, there is no alternative, but now there is alternatives that are interesting. And it's painful to have a year in the stock market down and the bond market. Most people have never seen that, certainly not since the 2000s. And look, think of all those grandmas out there that buying those CDs. Finally, there's a little bit of hope for all of those people. It's been a great conversation, guys. I know we've moved around between the markets and Alex's new product, but that's what we do here at ETF Edge. That does it for this week's show. And my thanks, by the way, to Alex and John. We've asked John to stick around a bit longer, chat about this down 20% year in the S&P and what he's telling investors. And remember, you can see all of our shows on our website, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter. Your weekly update on the hottest trends, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.